Welcome to This Week in Money. I'm Jim Goddard. Today, Kaiser researches John Kaiser on how 3D printing might slam China's economy. Market historian Bob Hoye looks at where you might profit in slow times. And business venture expert Martyn Element says uranium's low could lead to new highs. We'll talk to John Kaiser right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is John Kaiser, founder of Kaiser Research, and you can find him online at which it seems to me every week it changes, John.
No, it's now KaiserResearch.com, though the way the market's going, might have to turn it back to KaiserBottomfish.com.
Yes, that's the one I was used to. John, right now, what are the bottom fish and where should we be fishing or hunting?
Well, we are now into the fourth year of a resource sector bear market after an apparent turnaround during the first quarter where we saw nearly $1 billion of capital flow into the more advanced gold projects listed on the TSX and TSX Venture. And we were starting to see some capital flow into the exploration companies by March, but about mid-March when gold retreated from its challenge at $1,400, it's like we have rolled over, and now we hear all this talk about sell in May and go away, and the PDAC curse is back in effect, and it looks, and I can see the stocks trading below a dime, which peaked at 59% the end of last year and had dropped to below 50%. Now they're back to 54%, and we're back into this grind of the resource sector being gradually wiped out with no significant uptrends in metal prices to help us out and no major discoveries to inspire high net worth investors or retail investors to jump into the discovery company and any tag-alongs that might qualify as area play satellites.
Wow, it sounds almost like, I don't know who said it, it was back in 1899, some major American industrialist said, close down the patent office. There's nothing new to be discovered. We have the telephone, the telegraph, the railway. Who needs more? It sounds like we're almost there.
Well, the problem is, discoveries when you're tinkering and doing things like that, somebody working just with their brains and hands and a few little materials they've scavenged together can come up with something new and wonderful and totally confound the declaration that there's nothing to be found. But mineral exploration requires capital, a lot of capital, especially with all the work that has been done in the last 50 years. You can't just walk around the mountains and bang rocks and make a discovery that's been sitting there waiting to be found the way it used to be done. You have to look undercover. You have to drill through barren rocks. You have to make a case as to why this is not going to be a waste of a couple $1 million. And that is very hard to do in the current investment climate. The idea of a Cinderella story becoming reality, that has vanished from the public's consciousness. There's this perception that nobody will ever make any great discovery again, but with nobody, hardly anybody drilling and putting money into the ground, well, then that prediction will become true. And that's the kind of nasty chicken and the egg problem that the resource sector is settling into.
Because right now, resource prices are low or they're not growing. It's very expensive. So people will just sit there. What happens when the Earth's population grows by another billion and people just need something to make a pen or a razor blade?
Well, see, we like to think that Canada or Canadian mining industry is the center of the universe, and to some degree, one can say it was close to the center of the universe, but that it doesn't have to stay that way. The Chinese have their little delegations of mining experts all around the world doing stuff backed by their state-owned enterprises with a seemingly endless amount of capital behind them. The Australians, who are really the true competitors to the Canadians, they are also limping along right now, but they don't quite have the dysfunctional market structure that we have developed here in Canada, where we have tried to join the United States in the race to the bottom in terms of destroying the equity markets as a price discovery mechanism. So in terms of the world's future raw material needs, if the Canadian mining industry as a publicly listed venture capital entity fizzles and disappears, the world's not going to be at a loss. Somebody else, the Chinese or whomever, maybe the Russians, they will step into the breach and fill and do the job. It's just going to be a shame that Canada is going to wither away as this great fountain of exploration activity around the world, a fountain that exploded during the 90s when the Canadians were the ones that led the charge into all those third world frontiers that opened up after the end of the Cold War.
Agree with global warming, climate change, whatever. I saw a study that said one country that would benefit from that is Canada. All that area in the north covered by ice and snow will be uncovered. New rocks to chisel and look at.
Well, this is happening in places like Greenland, for example, which is completely glacier covered. As those glaciers recede, there's going to be all kinds of interesting stuff sticking out of the ground, but that will take decades to happen, and it's not really realistic to sit there now and wait for that to happen, at least not for juniors, which have to spend several $100,000 a year to just stay alive as a public company. They can't afford to do that. And by the way, the statistics on this are absolutely dreadful. Of the 1,700 companies that I cover that are supposed to be involved in the resource sector, almost 700, 40% have negative working capital, and another 20% have between 0 and 500,000 working capital, which is just enough to stay around and wait for market circumstances to change, but not enough to get anything done. There's only about 600 companies left with enough money to do anything, but they are all most of them are in this mode of hibernation, saying, if we spend the money and don't come up with a barn burner hole, we will not be able to replace it. So let's just go into hibernation and wait for this to get much worse. And if it does get much worse, many of those companies with no money or just a little, they're going to end up doing deals that will allow us to grab their assets for next to nothing. There's almost a war underway right now on all those shareholders who stuck it out, who stayed in these little companies that are now at a dime and that can't raise any meaningful money. And there's this giant pack of wolves prowling around, grinding them down to nothing, trying to wipe out the stake that the minority shareholders still have in this sector.
So I don't know if they're the wolves of Wall Street, but maybe the wolves of Howe Street are circling.
Okay, well, maybe we should just call them the coyotes of Howe Street, since they're not
I was going to say,
Wall Street guys.
Right, the little guys nipping at your heels and maybe stealing a chicken or two.
That's right. That's sort of the scale of things.
And that's very sad for Canada. Yet, on the other hand, when it comes to the brain equity we have in mining, mineral exploration, is that another asset? But again, a company might have 30 people like that instead of 3,000, hammering away at a mine.
Well, this is the other tragedy that's unfolding, in that there is a demographic hole in the technical mining, exploration, and engineering sector, and the bulge is now heading into the 65 and over period. And a whole bunch of them were, in retirement when the last decade took off, and they were hauled out of retirement, and they got great salaries, and they got options in all these juniors as these juniors wandered down this development cycle to go beyond just drilling holes to make a discovery, but also into feasibility demonstration. But now nobody can pay a meaningful salary. Options are useless because everything just goes down from whatever the price the options are set at, and then the stock gets rolled back, and then it goes set new options, and then it goes down again and gets refinanced. So we have all these knowledgeable technical people kind of saying, well, I think I am done with that. And as they settle into retirement, and it may take several years for this cycle to get properly going again, they are not coming back. And the youngsters that started studying this stuff in the past decade, they will not have the experience to fully step into the shoes of their elders who are now retiring. So this is also a structural problem in this industry, and to some degree, this is a problem everywhere in the Western world.
Yes, everybody's been in a big hurry. I mean, personally, I have to admit, anyone over 50 in my company was let go. And yet I have rookies in that business calling me, what do I do now? Sorry, I don't work there.
Yes. That's sort of destruction of the talent pool.
Maybe they saved a couple of dollars, but so what are we going to do? So we have a lag period here. Obviously, at some point, we're going to hit a critical mass where all of a sudden commodities are going to explode again. Can people wait?
The public can wait. I mean, they can forget about it and just have their money and put it into the funeral homes and the retirement homes and all these other entities that the rocking chair nation brokerage firms are serving up as things to invest in Canada. I myself have looked at all this and say, I can't wait for gold to do something wonderful. I can't wait for somebody to risk a drill hole and come up with a discovery that Mother Nature finally coughs up to create some excitement. So I've scoured all the companies out there and found one which has a story that can stand alone. And this company, EMC Metals Corp., in which I am a shareholder, they are $3 million away from having title to a Scandium deposit in Australia that has $9 billion worth of $800 rock in the ground. And you might think, wow, that's the equivalent of like a 7 million ounce gold deposit with 20 gram per ton grade, which would be phenomenal. The problem is Scandium is a metal of which only about $20 million is traded a year, and that is because there is no supply other than from various byproduct sources. It is a metal for which there could be 300 to 400 tons of demand a year.
John, can I be rude and just ask, what is Scandium?
Well, it's called Scandium because it was first isolated as an element in Scandinavia. It's similar to a rare earth, but it's not normally in the rare earth group. It's more similar to titanium and aluminum, and it's the fact that it alloys extraordinarily well with aluminum and changes aluminum's properties in a big way. It makes it stronger. It makes it more conductive. It has a higher melting point. This is, of course, why the Soviets, who had the only primary mine in the world, used it to build their MiG fighter jets during the Cold War. But this thing could change completely how the airline industry makes its airplanes. It could change a lot of the components in the automotive industry as they shoot for that 54 mile per gallon efficiency standard that's set for 2025. And most importantly, there's a company down here in California, Bloom Energy, which has now installed 100 megawatts of their Bloom boxes, which is a solid oxide fuel cell, which only really works at a commercial potential with a small input, about $30,000 worth of Scandium into it. And this company is going to be the thin edge of the wedge that breaks the chicken and the egg problem for the Scandium market.
More about Scandium of all things with John Kaiser next on This Week in Money.
Always consult your investment professional before making any investment decision. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. My guest is John Kaiser. John, you said Scandium is the hottest new metal. Does Canada have any of it?
Scandium is everywhere. If you go into the dirt in your backyard, you'll probably find 20, 22 grams per ton in it. But that is very difficult to get out. You need a grade of about 300 grams per ton. There are pegmatite deposits in places like Norway and Madagascar, which can get over 1,000 grams per ton. But the big exciting thing that's happened in Australia, both New South Wales and Queensland, is that in the last 6 years, they have discovered deposits with grades of 200 to 500 grams per ton in lateritic ores that are very close to surface, that you just can open pit mine with a fairly low strip ratio. So for the first time in the world, there is a potentially significant primary scandium supply available, which is why this thing I regard as a transformational play. Yes, you can't look up the price and see how much is done, but this is a field of dream story. If you put the capital into this and build it, the end users will come. But it's a classic chicken egg because the mining industry doesn't like to build anything for which there isn't a guaranteed offtake market. And the technology guys, the end users who could benefit enormously from this stuff, are so horrified by the messiness of the mining industry that they want nothing whatsoever to do with it.
But
this
right here, I was going to say, right here in Canada, in Alberta, I have seen open pit mines. I grew up around those, and now they're beautiful parks with wildlife everywhere.
Well, one of the big changes in the last 30 years over which the mining industry grumbled a lot is the environmental standards for remediation and so on have changed extraordinarily. And of course, it has raised the cost of stuff. Even though we have, metal prices that are much higher than they were, say, 20 years ago, much of that gain has been clawed away by the fact that now you cannot just dump your effluent into the local river or pile your tailings onto the landscape and not worry about the acid generating capacity. Now you cannot leave your mine site a super fun cleanup site for somebody else to clean up while you take your money and run. Now,
even China has now discovered that. I mean, they're polluting their people to death.
That's right. I mean, they had a study done several years ago, a soil study, and its conclusion was that their entire agricultural food chain was contaminated with heavy metals, largely because everything gets dumped into the rivers, and the rivers are what irrigate all their crops. This thing became such a volatile issue that they turned it into a state secret, and they're now scrambling to clamp down on all these mines and smelters and refiners and factories that manufacture all this other stuff from just dumping their costs onto everybody else and scooping the profit. And that's going to balance the playing field between the West and China. China is no longer going to be that place where you get to get stuff made cheaply because in your own country you're not allowed to dump the waste onto somebody else's backyard.
And of course, the boogeyman sitting there in the room, 3D printing. What will that do to China's industry of making little tiny things?
Well, this is a big problem for China because when they start talking about automating a lot of these processes right now, which in China currently employ a lot of people, China is going to have to deal with this problem. Okay, so now these people, we've replaced them with automation. What do we have them do? I think it's a 3D printing has a much bigger deal for countries in the West where we've already wiped out the factory worker and we have limited manufacturing. Now we can go back and do 3D printing, do automated stuff, which requires a much smaller employment footprint, but at least it bases the manufacturing of these goods, these physical goods, in your country rather than overseas, and then you skip the shipping costs of transporting these goods over these extraordinary distances, and then you also avoid the strategic vulnerability of say what we're seeing happening in Ukraine. China says, well, if Russia can annex Crimea and the part of Ukraine that's Russian speaking, maybe we should get serious about annexing Taiwan and say enough of you guys being this independent breakaway nation, and then watch and see how the rest of the world reacts. And the rest of the world reacts and says, oh boy, that's no good. We're not going to trade with you. Well, if you've got your factories in China, that's going to be kind of not so good. Just as right now the Europeans are sort of saying, maybe we shouldn't really be mad at Putin for annexing the Crimea and the Ukraine because we have so much at stake.
And I've also seen diagrams right now on how you could make your own 3D car at home, making major components and making all the instruments and everything. And it's $3,000 cheaper than buying it from somebody.
But you still need to engineer the design of it.
And my positive for Canada is you still need the raw materials to go into whatever you 3D.
Yes. And this is where, the scandium we were talking about earlier, aluminum powder to use in a 3D printer is not very effective because there's these problems with welding the powders. But when scandium is alloyed into aluminum, that powder is much more effective at allowing 3D printing of intricate components, and it has better corrosion resistance and conductivity and all these, and it's lighter. So, personally, I think the whole 3D printing business is going to be an explosion of innovation. Because what happened in the last few decades, if you wanted to do anything in the material world, you needed access to a giant machine shop, usually attached to a factory. Many of these factories moved to China and all that. So you didn't even have these places where the eggheads could go and do their skunkworks programs and develop the prototypes. With 3D printing and the powerful computers we can now have in our house, the idea of the garage tinkerer is becoming reality. You can design your stuff with your CAD system and when you're in your PC, and then you can hook up your printer and prototype these components and hook them up and see how they work. I think we're on the threshold of an explosion of innovation.
I think this is where Canada could also shine. We have an excellent education system that encourages people to learn more. I went back to BCIT when I was 54 years old, and believe me, I never felt dumber in my life. But I feel a whole much smarter now. At least I know more than just on and off. Yeah.
This is a perfect arena where Canada could excel with its excellent education system, its access to computing power, and its ready access to any of the materials that you could possibly need.
And the whole thing, too, I can imagine 50 years from now, 100 years from now, they will say, you burnt oil to run vehicles, but also we know petroleum, which Canada has in abundance, is used in so many industrial and commercial purposes that perhaps the average person doesn't even realize. You don't have to burn it to make money.
Yeah, the plastics industry is completely based on petroleum. Even if we stopped consuming gasoline as a transportation fuel, there would still remain an extraordinary market for oil-derived plastics products.
And I've heard, too, about biological changes where you have certain bacteria change oil automatically into plastic.
Yeah, you are harnessing biotech, organisms to transform materials. In the mining industry, this is an area where they are constantly doing R&D because many of these refractory ores, which takes intense energy input to break apart, they cannot be turned into raw materials because of the high energy input cost. But if you can harness bacteria to break down, and the bacteria are basically consuming oxygen and sunlight and whatever, they're harvesting their inputs at a microscopic scale and breaking apart these refractory minerals and releasing gold, copper, whatever. This is sort of a next frontier for recovery processes for the mining industry.
Let the gold bugs actually be gold bugs.
That's right.
John, is there a website people can go to learn more about you and your company?
Yes, it's called kaiserresearch.com, and you can see various stuff that you can see free, and if you want to access any of the restricted material, then you need to register and pick one of the subscriber options so that you can get access.
After the break, Bob Hoye on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to This Week in Money, Bob.
Yeah, Jim, good to be with you.
We'll be taking a look at the markets and what's been going on or might go on. So far, Bob, I know people have been asking me about the bond market. How's that been doing? Because people don't know what's going to happen in the stock market. We're expecting a big correction. Where should you be putting your money according to your statistics?
That's a good one, Jim. The bond market, lower grade bonds have been fabulous, absolutely superb bull market. Beyond investment valuations. I mean, it's become a one-way street. It's highly reckless, but oftentimes you can have a bond rally in lower grade garbage bonds, and it can run right up into May, and it's been a bull market killer. So this is what our view has been, and on some of the issues like junk and stuff like that, a few weeks ago did have the overbought signal. The price has continued to new highs recently, and that of course means new lows for yield. So we would be getting out of all lower grade bonds. I know that people are going to have to suffer a decline in income, but it's best to stand aside. Now, here's another one that's going on, is that that rally in junk bonds has been relative and stronger than any strength in long government bonds like Government of Canada's or U.S. Treasury bonds. They've been the laggards because they yield less. But what's happening here is that underneath it all, the whole party is always people get leveraged and on margin. And once a month, the figures are published from the New York Stock Exchange on credit balances and debit balances. And we got this back to 2000, and it shows the huge expansion of margin, if we call it that. And it goes up, and it ran for, I think, 3 months in a row, 4 months, very impetuous to the spike. And then the first decline in the monthly report on margin says that, hey, that's the end of ambition there. And we had that. The number for March just came out and the other day, and it's had the reversal. So this means that the whole bubble of stocks and lower grade bonds is now really vulnerable. So, but we also ran it against the price of the bond future, and this launches a rally in long U.S. The bond future. So, what one would be doing is getting out of risky bonds. Most corporates, certainly municipals, European bonds, anything that's slightly lower grade, just get the hell out of. And for nimble traders, one could take a position in the bond, longer maturities in U.S. Treasuries. I think the U.S. dollar could go up, so for Canadian accounts, that would be an interesting play as well. So, but for investors who can't trade, what are you going to do if you come out of these, well, formerly high-yielding, lower-grade bonds? Is that you got to find some place to park. So bank deposits are next to nothing. If you buy Treasury bills, that's next to nothing yield. So one could go out and buy a 3 or 4 year AAA corporate bond, high-grade bond. So you would get some income, and you would be protected against the price change on high-grade bonds. So that would be the safe thing to do. And gosh, the question, Jim, couldn't have been better timed, because it's just at the moment where a number of our research pieces have fallen into place. The other thing on the bigger picture is that again, it ties to the strength in lower grade bonds, in April. The other one is you can get a seasonal low in gold for April, which we've had. And today's interesting because the stock market started off like it wanted to go up, and then it set back. And with that, gold and silver started to improve quite nicely. So that opposite trade seems to be in play. You've got, and there's some of the gold stocks are firming up today after being, 3 or 4 weeks down. So we're going to get that rotation from the hot stuff now to the other stuff. So now also what we're looking at too is that in Canada, the oil patch stocks, either the seniors or the junior plays, the seniors were up more than 40% since the low, and you recall that we had called it a rotation back at Christmas time where these material resource type stocks were dismal, and we expected them to look good at least out into March. And the junior junior petroleum index of oil stocks, it's up more than 80%. So this is really an outstanding return, and it's time to take some money off the table on that one as well. And then this gets us out to where we are on the big picture on the economy itself, which we figured on the first business expansion out of a classic bubble and crash that it would be a weak recovery. And it's turned out to have run for 5 years. That was sort of similar from 1932 to 1937. And out of that classic bubble and crash. So we're at the point where the economy is getting not strong, but mature in age. So our guess is that the stock market's way over too much speculation, and the economy, so we think there'd be good or positive economic numbers right to the end, and when the stock market rolls over in the next month, you would then start to find it with softer economic reports, so then the two will feeding on each other. And I guess lastly, we would like to look at the gold stocks.
And what is the case with gold? I know with so many experts predicting a downturn in the equity markets this year, is gold the place to be?
Well, yes, if you're a trader. Now, for an investor on the long term, one should sort of have some gold, in a safety deposit box, and then as the saying goes, a few small gold coins, in case you have to leave the country in a hurry and want to bribe the border guards. But at any rate, gold in a post-bubble contraction is a very good place to be, because what happens is the price of mining and the price of costs of mining, you got to buy energy and all that sort of stuff, fall relative to the price of gold. So where in a post-bubble contraction, the price of most things become very weak, which will be the case once this recession starts, where those things go down, it really helps out on the gold side. So longer term, you'd want to be invested in the precious metal sector. But on the near term here now, we got this opposite play going on, whereby for the last 5-6 weeks you've had good action in orthodox investments in the commodities, in lower grade bonds, and in the stock market. And against that, the precious metal sector was a little soggy and weak. So now here it is, right here on Friday. You've got a reversal going on. You've the stock market open firm and is declining. And with that, gold and silver firmed up. It's kind of nice to see, and especially when you were looking for weakness through April. And here we are early into May, and it's starting to improve. But this trade on now for precious metals could be brief, because if we do go into a severe correction in the stock market, the gold stocks would get marked down as well. So here's the wrap. People should own some gold in their safety deposit box. Those who are more nimble could take a trade for a few weeks in here on the long side on some gold stocks. But what you want to watch for is if the gold-silver ratio, which is always our benchmark, when it begins to act like a credit spread, our benchmark here was that the gold-silver ratio, which a number of months ago was at 60, meaning it was low, meant party time, and then it rose up and traded around 65 and 66 for a while. But in order to break through on the chart, you had to get up into the 67. So we spent now 2 days in the 67 range, and for us, that is the signal that there is a credit crisis, somewhere should become visible within a couple of months. So one has to be cautious in that regard. So long term, you're looking at a cyclical decline for the orthodox investments. And again, long term, you're expecting the precious metals, particularly gold and gold stocks, to be really good performers. Let's say from later in the year on out. We've got some financial troubles to be discovered here that could be revealed in the next few months.
Should people be following that old slogan, sell in May and go away, but in this case, maybe run away?
Very good, Jim. You know, they're available, these studies, where roughly there's a 4-year cycle on stocks and business cycle, and sometimes it sort of coincides with the U.S. presidential election year cycle. So this is in this year, this model would call for a high in the stock market in April, early May, and then using that typical for this year of the election cycle, then you would have a low in late September. And yes, that is part of the old saw of sell in May and go away. And but that's sort of a general advisory thing, and that's our outlook for the month of May.
With that cycle too, I think because of quantitative easing, everything seems either to happen a lot earlier or a lot later than what history would tell us it should happen.
Well, there have been some distortions, but keep in mind that while the Federal Reserve has been reckless in buying low grade and Treasury bonds, the market has been buying with the Fed. And there's also, you've got most bond trading desks in the world trade on huge leverage. So then you have this, everybody is playing with the Fed, and once the momentum goes out of the move, and here's a seasonal move that in previous years the Fed has been unable to do anything about it, because you go back to 1998 with the long-term capital management crisis, where that big fund then, and it was a highly regarded team, and they were playing the spread market for spreads to narrow, and of course the spreads narrow into May, and then they reversed, and they did reverse. So what got the LTCM was a seasonal play in credit spreads. And now keep in mind also then that the Fed was lending money, along with other senior central banks, were lending money directly to LTCM. And one poor national central bank, the Italian bank, was so excited about the prospects that it even took a equity position in the fund. So when it went bad, it was very exciting. I remember Citigroup bank stock fell by 40% from it was August until October. That was a good one. But so here we are. You've got seasonal forces that have been there for decades, and the problem is that when you have great excitement going into when a season can reverse, such as in May, your chances are you'll get the reversal, and it'll overwhelm whatever the buying the Fed has been doing. I think they are close to discovering an embarrassment on their own part.
Bob, is there a website people can go to find out more about what you do and your company?
Oh, yeah. We've got institutionaladvisors.com, or actually, and this is one of the wonders of the Internet, if you just Google my name, B-O-B-H-O-Y-E, all of our work comes up, and you can just get into it. And it's a miracle of modern science.
After the break, Martyn Element on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Martyn Element of Element and Associates in Vancouver. He's a corporate consultant who I like to say digs up new pursuits, money, ideas. Martyn, what's the big idea on your mind right now?
Boots on the ground, Martyn Element in the trenches. Well, the big idea is really the knock that uranium has had over the last few weeks, and a lot of it is because the uranium plays that we talk about a lot is in the Athabasca Basin, and this time of the year you have, which a lot of people will know what terminology, breakup, where the icy hard ground starts to break up, and all the drilling programs that have been going on these hardened grounds are remobbing and moving to possibly areas where they continue drilling. Well, unfortunately, with the price of the uranium dropping down significantly, I think I'm right in saying to a 10-year low, the combination of that and the moving and the relocating of a lot of these uranium plays has caused a significant decrease in value of these deals, as much as 37% in a lot of them, including some of the major firms. And it's realignment time, but as I've said before, it depends at the strong at heart, and we're able to see the opportunities to say, well, this happened this time last year. If you look at a lot of the graphs of these uranium plays, and that came back again.
And plus, we have all these atomic power plants around the world about to go back online or to be built. This is a matter of patience will pay off, won't it?
I believe so. That, if you're talking years, yes. If you're talking months, possibly not a predicament to be in for the faint of heart. But then again, we've said so many times about these investments, particularly with these juniors or micro stocks, and some of these, even these mid-sized juniors, particularly on the micro, smaller stocks that we have a lot of involvement here in this part of the world. You should not be using money that I hesitate to say, because it is a big statement, you can't afford to lose, that you can afford to lose, because if you can't hang on now and you've got to pay the rent with money you've gone and bought some of these uranium stocks, and they've gone down from $1.65 down to $1.25, and you think, oh boy, it looks like it could go to 75 or $1, I'm going to have to sell. Well, it might go down a little lower, but I think overall and within time, of course, you could be going to much higher than 165.
Apparently, Canada is still a huge diamond country.
Well, we are, and I think it's quality and for richness. I think we do have the richest diamond mine in the world up there from these more recent discoveries. But we started talking about something with a realignment and opportunities and watching yourself with these uranium situations on a general picture. And I'd like to finish up with a positive note that diamonds have done very, very well over the last little while, some of these stocks. And I don't think that the summer is going to be a lot different. I think we could see a lot of activity in a lot of these junior diamond stocks, and the ones to look out for are the ones that are well financed and well run. Of course, that goes without saying. The 3 Ps: pricing, people, and product.
And De Beers.
And De Beers, and the 3 Ps with a D. So I just think that, as much as we've got 2 significant juggernaut situations that are going on with the uranium, I think that the diamond will be as juggernaut, potentially something that needs to be kept a close eye on, and work with your advisors and some of the people that have some knowledge in these areas. Always do that. But I think there'll be some really good positive energy around some of these diamond stocks during the summer, and that's what I believe will make a big difference to the business in general.
Martyn, is there a website people can go to learn more about your business?
Well, I'm really involved in consulting on financing and finding these deals. Martyn Element and Associates.com is my website.
Thanks to our guests, John Kaiser, Bob Hoye, and Martyn Element, and thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.